Welcome to this CAMS exam preparation lesson on predicate crimes, their categories, the proceeds they generate, and the key typologies you need to master. A predicate crime is the foundation of every money laundering case. Without it, there is nothing to launder. The Financial Action Task Force, or FATF, designates 21 categories of predicate offences. Understanding these categories and how their proceeds flow is essential for the exam and for real-world compliance work. Let's build this knowledge step by step. We begin with the foundations. What exactly is a predicate offense and why does it matter so much in anti-money laundering law? A predicate offense is the unlawful activity that generates criminal proceeds which are subsequently laundered. Think of it this way. Without a predicate offense, there is no money laundering. The crime comes first, the laundering follows. For a prosecution to succeed, authorities generally must prove that the funds originated from a specific criminal act. The scope of what counts as a predicate offense varies by jurisdiction. Some countries enumerate specific crimes. Others use a threshold approach based on penalty severity. FATF recommends the broadest option, the all crimes approach, where any criminal offense can serve as the predicate. Why does this matter for the exam? Because a money laundering charge depends on establishing that funds have a criminal origin. If the predicate cannot be proven, the laundering charge may fail. The scope of predicate offenses in a jurisdiction directly defines what financial institutions must detect and report. A broader list means wider obligations for compliance teams. And the nexus, the connection between suspicious activity and a specific crime type, is what gives a suspicious activity report, or SAR, its analytical value. Remember this principle: no predicate offense, no money laundering. Now let's look at the FATF framework and the designated categories of predicate crime that form the backbone of international AML standards. FATF designates 21 categories of predicate offenses. You don't need to memorize all 21 word for word, but you must recognize the major groupings. These include drug trafficking and arms dealing, human trafficking and migrant smuggling, environmental crime and piracy, violent crimes like robbery, extortion, kidnapping, and murder, and financial crimes such as counterfeiting, forgery, and market manipulation. Notice that corruption, tax crimes, fraud, and terrorist financing are covered in separate lessons. This lesson focuses on the typologies that generate proceeds through physical crime, exploitation, and illicit trade. An important distinction for the exam is how jurisdictions define which crimes qualify as predicates. The all crimes approach means any criminal offense can serve as a predicate. This casts the widest net. The threshold approach limits predicates to crimes carrying a certain minimum penalty, such as 1 year of imprisonment. The list approach only recognizes specifically enumerated offenses. FATF recommends the all crimes approach because it closes gaps that criminals could otherwise exploit. Under this approach, virtually any criminal proceeds trigger money laundering liability. Know which approach your exam question describes. It changes the answer. Let's move to one of the most tested distinctions on the CAMS exam, the difference between human trafficking and human smuggling. These two crimes sound similar but are fundamentally different in purpose, consent, and duration. Human trafficking is about exploitation. The victim does not consent freely, or their consent is obtained through force, fraud, or coercion. The trafficker maintains ongoing control after arrival, extracting value from forced labor, sexual exploitation, or other services. The proceeds come from that exploitation. Human smuggling is about transportation. The migrant is a willing participant who pays to be moved across a border. The relationship between smuggler and migrant ends at the destination. The proceeds come from the transport fee itself. This distinction matters because the red flags, the laundering methods, and the victim profiles are completely different. On the exam, look for the word exploitation that points to trafficking. What does trafficking-related laundering look like in practice? Watch for multiple workers sharing a single bank account. This suggests third-party control. Wages deposited and immediately withdrawn by someone other than the account holder. Structured cash deposits from businesses like massage parlors, nail salons, or car washes, industries where traffickers force victims to work. And third-party control of victim bank cards, where the trafficker holds the card and PIN. Traffickers often funnel victims' earnings through cash-intensive front businesses to obscure the exploitation. The financial footprint is one of control. Someone else is directing the money. Now let's examine environmental crime, a rapidly growing source of illicit proceeds that is increasingly tested on the exam. Environmental crime encompasses illegal logging, illegal mining, illegal fishing, and illegal waste trafficking. Wildlife trafficking, the poaching and trade of endangered species, is a particularly high-profile subset. These crimes are estimated to generate the third largest criminal revenue stream globally, after drug trafficking and counterfeiting. The proceeds are often laundered through trade-based methods, mispriced goods, shell exporters, and complex supply chains that cross multiple jurisdictions. Front companies in the import-export sector are a favorite vehicle. The legitimate appearance of international trade provides cover for moving both the illicit goods and the criminal proceeds. Here is a critical red flag pattern for environmental crime. Watch for invoices that describe generic goods, like timber or wood products, but correspond to shipments originating from regions known for illegal logging or wildlife poaching. Unusual trade routes that don't make commercial sense. Shell companies acting as exporters with minimal operational history, and payments that are inconsistent with the commodity's market value, either far too low, suggesting under-invoicing, or far too high, suggesting over-invoicing to move value. Environmental crimes exploit weak customs oversight and complex supply chains. The more intermediaries and jurisdictions involved, the harder it is to trace the proceeds back to the predicate offense. Drug trafficking remains the most commonly cited predicate offense worldwide. Let's trace how its proceeds move through the financial system. Drug trafficking proceeds follow a predictable path. It begins with cash collection. Street-level sales generate bulk physical cash, typically in small denominations. Next comes placement, getting that cash into the financial system. This happens through structured deposits below reporting thresholds, through cash-intensive businesses that commingle illicit and legitimate funds, or through bulk cash smuggling across borders. Layering follows: wire transfers through multiple accounts, trade-based laundering, or conversion into cryptocurrency to obscure the trail. Finally, integration. The now clean funds are invested in real estate, luxury goods, or legitimate businesses. Understanding this sequence helps you identify where detection is most likely to succeed. The transactional red flags for drug trafficking center on cash. Bulk cash deposits in small denominations, 5s, 10s, 20s, that don't match the customer's stated business. Rapid movement of funds through multiple accounts with no apparent economic purpose. Purchases of high-value portable assets like watches, vehicles, or gold. And unexplained wealth in customers operating cash-heavy businesses with revenues that far exceed what the business model should generate. Drug proceeds typically enter the financial system as physical cash. That makes placement the most vulnerable stage for detection, and the stage where your transaction monitoring rules should be sharpest. Now that we understand the major typologies, let's look at how institutions should respond with proportionate AML controls. Effective detection rests on 4 pillars. First, transaction monitoring, with rules specifically tuned to crime-specific patterns. Structuring rules catch drug placement. Trade value anomaly rules catch environmental crime. Each typology demands its own detection logic. Second, enhanced due diligence or EDD. Deeper scrutiny for customers in high-risk industries, geographies, or with profiles that match predicate crime typologies. Third, suspicious activity reporting. Filing SARs when transactional indicators align with known predicate crime patterns. The quality of a SAR depends on connecting the dots to a likely predicate. Fourth, training and awareness. Ensuring frontline staff recognize evolving red flags for each crime category. A teller who understands trafficking indicators is your first line of defense. Regardless of the predicate crime, proceeds tend to flow through a common set of laundering channels. At the center are the proceeds themselves. Radiating outward, we see cash-intensive businesses used to commingle funds, trade-based laundering to move value across borders, real estate investment for high-value placement, shell and front companies to obscure ownership, cryptocurrency platforms for pseudonymous transfers, and professional intermediaries, lawyers, accountants, real estate agents who may wittingly or unwittingly facilitate the process. Recognizing these channels helps you spot laundering regardless of which predicate crime generated the funds. Let's test your knowledge. Here is the first question. What is the primary legal significance of a predicate offense in a money laundering prosecution? Is it A. It determines the sentence length for the laundering charge. B. It establishes that funds originated from criminal activity. C. It identifies which financial institution failed its AML duties. Or D. It defines the jurisdiction where the trial must take place. Pause and consider your answer. The correct answer is B. It establishes that funds originated from criminal activity. A money laundering charge requires proof that the funds in question were derived from a criminal act. The predicate offense is the underlying crime that generated those proceeds. Without establishing this criminal origin, the laundering charge cannot stand. Sentence length, institutional failures, and jurisdictional questions are separate legal matters. Question 2. Which characteristic most clearly distinguishes human trafficking from human smuggling? A. Trafficking always involves crossing an international border. B. Smuggling involves ongoing exploitation after arrival. C. Trafficking involves exploitation and ongoing control of the victim. Or D. Smuggling generates larger criminal proceeds than trafficking. Think carefully about the defining element. The correct answer is C. Trafficking involves exploitation and ongoing control of the victim. This is the defining distinction. Trafficking is about exploitation and continued control. Smuggling is a transportation crime where the relationship ends upon arrival. Importantly, trafficking does not require crossing an international border. It can occur entirely within one country. And smuggling does not involve ongoing exploitation. On the exam, exploitation equals trafficking, every time. Final question. A customer operating a small import business receives wire transfers from a region known for illegal logging, with invoices describing generic lumber at prices well below market value. Which predicate crime typology does this most closely match? A. Drug trafficking through trade-based laundering. B. Environmental crime using mispriced trade invoices. Or C. Human smuggling with fee-based wire payments. Consider the geographic risk, the commodity, and the pricing anomaly. The correct answer is B. Environmental crime using mispriced trade invoices. The combination of a high-risk geographic origin for illegal logging, generic commodity descriptions, and below-market pricing are classic indicators of environmental crime proceeds laundered through trade-based methods. While drug trafficking also uses trade-based laundering, the specific goods, lumber, and the geographic risk point clearly to environmental crime. Always match the indicators to the most specific typology available. Let's recap what we covered in this lesson. A predicate offense is the underlying crime that generates the proceeds to be laundered. No predicate, no laundering. FATF designates 21 categories, and the all crimes approach is the recommended standard. Human trafficking is defined by exploitation and ongoing control, while smuggling is purely a transportation crime. That distinction is heavily tested. Environmental crime is the third largest criminal revenue stream and relies on trade-based laundering through complex supply chains. Drug trafficking proceeds enter the system as cash, making placement the critical detection point. And your controls must be crime-specific. Tuned monitoring rules, enhanced due diligence, quality SAR filing, and trained staff. For the exam, always identify the predicate offense first. It determines the laundering typology, the red flags you should look for, and the appropriate control response. Master that logic, and these questions become straightforward.